Something unusual is happening in the Bitcoin market right now, and it is not just price volatility, ETF headlines, or another round of social media hype. The tone has shifted. The people speaking have shifted. The conviction feels different. When Cathie Wood says Bitcoin is about to disrupt the existing world order, that is not a casual comment thrown into the noise of crypto Twitter. That is the CEO of ARK Invest, a firm built on identifying technological revolutions early, saying the monetary system itself is about to be challenged.
No, I don't think so. Bitcoin is a hedge against inflation and deflation because the chaotic part of this is, and it's ripping through the markets now, a lot of traditional industries and companies being brought, the whole SaaS space, the disaster, as they're calling it. We think there is merit to that particular one, but I think you're going to see disruption all over the place because the 5 innovation platforms that I mentioned are going to disrupt the existing world order.
At Bitcoin Investor Week in New York, in a conversation with Anthony Pompliano, Cathie Wood laid out a thesis that goes beyond the usual inflation hedge narrative. For years, Bitcoin's story has been simple. Central banks print money, currencies lose purchasing power, and Bitcoin with its fixed supply stands as protection. But Wood is now arguing that the bigger shock ahead is not inflation. It is deflation driven by exponential technology. Artificial intelligence, robotics, automation, and rapid productivity gains are collapsing costs at speeds that traditional institutions are not prepared for. She cited how AI training costs are falling dramatically each year and how inference costs are collapsing even faster. Businesses can suddenly do more with fewer inputs, which pushes prices down and compresses margins. In a world built on debt and steady inflation, that kind of productivity shock can create serious stress. Her warning is subtle but powerful. If the Federal Reserve and legacy financial institutions are still operating on backward-looking data, they risk reacting too late. In a deflationary productivity wave, debt becomes heavier in real terms. Over-leveraged structures become fragile. Private equity, private credit, and debt-fueled growth models begin to strain. That is the environment Wood describes as deflationary chaos. And in that chaos, she believes Bitcoin's simplicity becomes an advantage. It does not depend on trust in an institution. It does not rely on a central counterparty. It has a fixed supply and a decentralized architecture. In her view, that design makes Bitcoin a hedge not only against inflation, but also against systemic disruption caused by innovation itself. What makes this moment interesting is that Wood framed it as the opposite of the dot-com bubble. Back then, capital rushed into technology before the infrastructure was ready. Today, she argues the infrastructure is real and markets are underestimating it. AI works. Blockchain works. Tokenization is happening. The disruption is not theoretical anymore. When she says Bitcoin could disrupt the world order, she is not talking about a meme coin rally. She is talking about a shift in how value is stored and transferred in a world where productivity accelerates faster than policymakers can adapt. At the same time, James Lavish is approaching the same market from a different angle. He calls what is happening with Bitcoin an information arbitrage. That phrase is worth sitting with. Information arbitrage means the asset is mispriced not because of hidden data, but because most people do not yet understand what they are looking at.
What we are experiencing right now, Danny, is an information or a knowledge arbitrage.
Yeah.
And so people just do not yet understand how Bitcoin is different and why it is the ultimate store of value and the ultimate debasement asset. They just don't understand it yet. There's a lot of confusion. There, the mainstream media puts out confusing and hit pieces about it all the time. They commingle it with all the other cryptocurrencies, and they just call them all the same thing. And so I have friends who say, "Oh yeah, I own that. I own Bitcoin. I own the Solana one." And it's like they just don't get it, and it's okay. It's not their fault. They're just not interested in doing the research themselves, and they're listening to mainstream media and getting their news off of Facebook or their research off of Facebook. They're just not getting it. And so there is an information arbitrage that you and I are experiencing right now. It feels bad, and it makes you feel like, am I an idiot? Am I just stupid that I'm how early am I here? And the answer is you're still pretty early, because I think that Bitcoin is going to trade above $1 million in early 2030s. 2032, 2033, I would be very surprised if we're not touching $1 million Bitcoin. That's me. That's my thesis. That's where I believe this thing is going. But I also believe that part of that is that arbitrage, that knowledge arbitrage will close. And as that does, you're going to have the Harvards and the Yales and the University of Texas and the CalPERS and the Texas teachers and every pension and fire fund out there taking positions in Bitcoin as a core asset. And when they do that, that's when that knowledge begins to really spread, and people are like, oh, yeah, so Bitcoin is different. Okay, so Bitcoin is different. It's not just this moonshot thing. It's digital gold. Okay, then I should probably own some. And funny enough, is I think that that's going to be a much healthier rise for Bitcoin in price and a much more stable rise. It's not going to be this massive volatile thing. It's going to be like people are, oh, I get it. Okay, I get it. Oh, okay, I understand now. I understand how it's different. And then we'll feel vindicated, and we'll look like we're 143 years old when we're just in our 50s, or in your case, 30s.
Lavish has said he believes Bitcoin will trade above $1 million in the early 2000s and 30s. That is not framed as a wild guess. It is framed as a consequence of Bitcoin being the ultimate debasement asset and ultimate store of value. In his view, the gap between what Bitcoin is and what most investors think it is creates opportunity. The people who understand accumulate quietly, while the majority debates whether Bitcoin is just another speculative tech trade. That debate is exactly where Lyn Alden enters the conversation. She recently described Bitcoin as trading like a risk-on asset while having risk-off properties. That line perfectly captures the tension of this cycle.
Well, so historically, when we look at Bitcoin price action, outside of very narrow examples like the COVID stimulus, usually Bitcoin doesn't have V-shaped bottoms. Usually it hits a floor, goes sideways for quite a while. I think we're in more of that range now. In November, it tried to find a bottom and did so for maybe 2 months before falling over again. So we can't guarantee there won't be another cascade lower. But I wouldn't expect like a very rapid recovery because I don't really see any sort of like massive stimulus on the horizon. So I think it takes time. And really the mechanism that it finds the floor is you get kind of the more like, the term is like diamond hand holders. Like they kind of come in very value oriented. They really know what they own, and they don't want to sell, and they start scooping up cheap coins. And because the new supply is so low, and because the market cap's not that big, it only takes a fairly small number of them to start really kind of putting a floor in.
On shorter time frames, Bitcoin has been moving alongside growth stocks. Analysts have noted its correlation with software equities rather than with gold. When technology names sell off, Bitcoin often feels the pressure. From its peak above $126,000, it has pulled back significantly, hovering in the mid-$60,000 range with sharp intraday swings. Gold, meanwhile, has climbed as geopolitical tension drives capital into traditional safe havens. Critics look at that divergence and conclude that Bitcoin has failed its digital gold test. But Alden's point is deeper. In the short term, capital flows dominate. As Bitcoin becomes integrated into institutional portfolios through ETFs and traditional market infrastructure, it will naturally reflect broader risk appetite. In the long term, however, its use case as a neutral digital monetary protocol remains intact. It has the network effect, it has the security, it has a transparent supply schedule. Those qualities do not vanish because it trades in sympathy with tech stocks during a correction. They take time to assert themselves at scale. However, Tom Lee sees the current environment through yet another lens. Speaking on CNBC, he argued that all the pieces are in place for Bitcoin to bottom.
It looks really like it's bottoming because the fundamental story of crypto is quite positive. Davos shows banks are really embracing crypto. There's regulatory bills coming that are favorable to crypto. And in fact, we saw an announcement even today. BlackRock is going into DeFi with Uniswap. I mean, people might say that's a degen move. So crypto has a lot of sort of tailwinds, but the price action is terrible.
His confidence is grounded in both technical and structural factors. He referenced the work of Tom DeMark, known for identifying moments when selling pressure exhausts itself. According to Lee, the rare alignment of time and price that DeMark looks for has appeared. That suggests that the recent wave of selling may have run its course. Beyond charts, Lee emphasized that the market has been significantly deleveraged. Excess speculation and borrowed money were flushed out in prior months. Without dangerous leverage embedded in the system, cascading liquidations become less likely. In his words, crypto may be limping along, but it is fundamentally cleaner than before. He also highlighted something that often gets lost during price drawdowns. Network activity, especially in Ethereum and tokenization efforts, has been accelerating. Wall Street is experimenting with digital assets. Major institutions are exploring on-chain settlement and tokenized products. Lee described it as a kind of quiet breakthrough moment for blockchain technology happening beneath the surface. If usage expands while price stagnates, that gap rarely persists forever. Eventually, price catches up with fundamentals, or fundamentals deteriorate. In this case, Lee believes the structural growth is real and that price is lagging. Then there is Michael Saylor, who rarely speaks in half measures. He has called Bitcoin the only form of clean money, arguing that most of the economy runs on assets he describes as dirty or toxic.
We're at this inflection point, moving from economics as art, colored by superstition and religion and ideology. And we're crossing this boundary where economics becomes science and it's informed by mathematics and engineering, right? And the scientific method. But, you have to date that, in my opinion, to January 3rd, 2009, when Satoshi unleashes Bitcoin and there's a singularity, and all of a sudden there's actually engineering, physics, and mathematical principles that are starting to spread in a viral fashion through the economy. And it was like a nothing, and then it's $1 million fire, and then $1 billion network, and then a 10 billion, then 100 billion. Now it's a $1 trillion network, but still $1 trillion is 0.1% of the economy. So 0.1% of the economy has clean money, and 99.9% of the economy runs on dirty, toxic assets that are defective, that are operated by people that don't know they're trading defective assets. Because how would you know if you'd never seen clean? How do you know that you're dirty?
Saylor embraces volatility rather than apologizing for it. He has described it as both a bug and a feature. Yes, Bitcoin can be 2 to 4 times as volatile as traditional assets like gold or equities, but he also argues it has been 2 to 4 times as performant over longer horizons. Strategy, the company he co-founded, continues to accumulate Bitcoin quarter after quarter, now holding hundreds of thousands of coins with tens of billions invested. When asked about downside risk, Saylor has dismissed the idea that temporary price declines threaten the thesis. His framing is that digital capital represents a new foundation for financial instruments and that short-term fluctuations are the cost of long-term outperformance. While these high-profile voices debate bottom signals and macro shifts, on-chain data adds another layer. Reports indicate that new whales accumulated amounts of Bitcoin in January and February comparable to total accumulation in 2025. That is not retail panic buying. That is strategic positioning. At the same time, some research firms argue that the current drawdown resembles the early stage of a bear market. Bitcoin has declined for multiple consecutive months and sits well below its previous all-time high. The Fear and Greed Index has dropped into extreme fear territory. Net realized losses have surged, echoing moments seen in prior downturns. History, however, complicates the narrative. In past cycles, realized losses often peaked months before the ultimate price bottom formed. Capitulation is a process, not a single-day event. Markets grind down, confidence erodes, and then quietly, the foundation stabilizes. The disagreement among analysts today mirrors every previous cycle. Some see a structural top and the start of winter. Others see a correction within a broader secular expansion driven by adoption and technological convergence. This is exactly the divide playing out in today's market structure. As highlighted by popular ex-crypto influencer CW, he wrote, The amount of Bitcoin accumulated by new whales in January and February is comparable to the total accumulated in 2025. Their strong accumulation indicates they are preparing for a bull market, not a bear market. What makes this period compelling is the convergence of themes. Artificial intelligence is compressing costs and reshaping productivity. Traditional debt-based systems may struggle in a deflationary shock. Institutions are experimenting with tokenization and digital settlement layers. Influential investors like Cathie Wood, James Lavish, Lyn Alden, Tom Lee, and Michael Saylor are articulating long-term theses that extend far beyond short-term price action. At the same time, price remains volatile, sentiment fragile, and headlines mixed. The question is not whether Bitcoin is volatile. It is whether volatility obscures a structural shift. The question is not whether this is a correction or the start of a bear market. It is whether the long-term architecture of digital money is quietly strengthening while short-term narratives oscillate. If whales are accumulating, institutions are building, and technological forces are accelerating, then what happens when sentiment turns positive again? We are left with a market at a crossroads. Fear is measurable, volatility is visible, but conviction among certain long-term thinkers remains intact. Whether this moment becomes known as the early stage of another winter or the base before a new expansion will only be clear in retrospect. For now, the conversation has shifted from whether Bitcoin survives to whether it reshapes the system around it, and that is a very different debate from the one we were having just a few years ago. As we wrap up, do you think we are witnessing just another volatile phase in Bitcoin's cycle? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.